Stock valuation. Have you ever wondered about successful investors' methods of choosing winners consistently? What criteria do they use to predict which stocks prices will go up in the future? A stock's real value is determined by a procedure known as stock valuation. Mastering stock valuation abilities is essential if you wish to outperform the market with your investments. Using this method, you may determine whether a stock's current price represents a fair value. Stock valuation is a combination of art and science. So, this video is going to be very helpful for those who want to gain knowledge about stock valuation, because we are going to discuss what is stock valuation and what are different stock valuation methods. Why do stock market values fluctuate and how to find them accurately? How to analyze competitors? Why assign value to stocks? Stay until the end of this video so you don't miss the important information that will surely be going to help you in your stock valuation process. Why do stock market values fluctuate? Every day, market forces cause a revaluation of stock values. What we mean is that supply and demand affect share prices. The price rises when there is more demand for a stock relative to the number of persons willing to sell it. If, on the other hand, more individuals wanted to unload shares than acquire them, the stock's price would drop because supply outpaced demand. Supply and demand is a simple concept to grasp. The inexplicable nature of stock market sentiment makes it hard to fathom why some investors are bullish on one firm while others are bearish. Understanding what types of news are good and bad for a business is essential. The almost single investor you talk to will have a different take on how to solve this challenge. However, the central premise states that stock price fluctuation reveals how much investors value a firm. Remember that the stock price is not always indicative of the company's worth. The market capitalization of a corporation is equal to the stock price multiplied by the total number of outstanding shares of that company's stock. A firm worth 100 rupees per share with 1 million shares outstanding is worth 100 million rupees less than the same firm trading at 50 rupees with 5 million outstanding shares. The stock price is a complicated reflection of a firm's present worth and the expected rise in that value that investors have. Types of stock valuation. There are two primary kinds of stock valuation techniques: absolute and relative. Number 1, absolute. The absolute stock valuation approach emphasizes a company's fundamentals. Valuation is based on several indicators including cash flow, dividends, and growth rate, which are taken directly from the financial statements. The absolute approach of stock valuation requires the calculation of the dividend discount model (DDM), the discounted cash flow model (DCF), the residual income model (RIM), and the asset-based model. As its name implies, the absolute technique does not consider how the firm is doing concerning its competitors. For example, take company X, whose stock is selling for 370.5 rupees at the moment. An analyst does a discounted cash flow (DCF) analysis on the company's projected future cash flows and arrives at a total value of 450.3 rupees. If an investor believes that company X is undervalued, now is an excellent time to purchase. Number 2, relative. The relative valuation approach looks at the company in question through the lens of its peers by comparing key financial parameters. One standard method is to look at how similar businesses are doing. The relative valuation approach relies heavily on the PE ratio calculation. The present company's stocks are cheap, for example, if its PE ratio is lower than that of a comparable company. Let's see how this example can help. Company A said their diluted EPS for the fiscal year ending in January 2022 was 6.76 rupees, based on the stock price of 203 rupees at the time of reporting. Divide the share price by the earnings per share to get the price-earnings ratio. PE equals 203 rupees divided by 6.76 rupees, which equals 30.03 rupees. Price is the current market value of a company's shares, and EPS may be calculated from the company's financial filings. Stock valuation models. The process of determining a stock's value involves elements of both art and science. Investors can feel overwhelmed by the sheer number of places to find information about how to value stocks, like the company's financials, newspaper, economic reports, stock reports, etc. As a result, investors need to be able to separate essential data from irrelevant noise. A person who wants to invest should also know the most common ways to figure out how much a stock is worth and when those ways are most helpful. Model number 1, the dividend discount model (DDM). The absolute worth of a stock can be determined using the dividend discount model, which is a standard approach. The dividends paid to shareholders are used to calculate the actual value. According to analysts, investors should buy stocks at a fair price, and that price should be determined by the present value of future dividend payments. The dividend discount model valuation works well for large, steady dividend-paying firms. After then, the Gordon growth model is used by investors on the premise of a constant dividend growth rate. It's a simple strategy that eliminates the complexities of dividend payment. Let's have a look at the formula of dividend discount model (DDM) so that you can understand it completely. To calculate one period dividend model, use this formula. PV0 is the present value of the stock. D1 is the dividend at the end of 1 year. SP1 is the selling price of the stock at the end of 1 year. R is the discounted rate. To calculate multi-period dividend model, use this formula. PV0 is the present value of the stock. D1 to Dn are the dividends at the end of each year period. SPN is the selling price of the stock at the end of the nth period. R is the discount rate. Model number 2, Gordon Growth Model GGM. A stock's actual value is calculated by using the Gordon Growth Model GGM by projecting a steady increase in dividend payments into the future. This version of the dividend discount model is widely used since it is simple DDM. The GGM calculates the present value of an endless sequence of future payouts by assuming that they will increase at a constant pace indefinitely. Due to the model's dependence on the assumption of a constant growth rate, it is often used exclusively for corporations whose dividends per share have increased at a steady rate throughout time. For your better understanding, let's have a look at the formula for Gordon Growth Model, GGM. P sub 0 is the price fair value of the asset. D sub 1 is the expected dividend per share payout to common equity shareholders for next year. R is the required rate of return or the cost of capital. G is the expected dividend growth rate. Model number 3, the discounted cash flow models DCF. For companies that do not pay dividends or have an unpredictable payout plan, the discounted cash flow model is used by investors. A wide variety of non-blue chips enterprises may benefit from using the discounted cash flow model, including corporations that do not provide dividends. DCF may be calculated in several different methods. The two-stage discounted cash flow model is the most often used. It estimates future free cash flow for 5 to 10 years and then determines the terminal value of all cash flows. Firms without consistent and predictable free cash flow cannot be accurately valued using the DCF method. Thus, enterprises far beyond their development phase are the optimum candidates for DCF valuation. To get a clear idea of how to use discounted cash flow model DCF, let's have a look at this formula. CF is the cash flow for each consecutive period. R is the discount rate. Big companies often use WACC. Future cash flows that we anticipate receiving are discounted to their present value using a rate of return that we believe to be achievable at the time. An undervalued investment is one with a price that is lower than its discounted cash flow DCF. If the price is greater than the DCF, it is quite likely that the investment is overpriced. Analyze competitors. Relative stock valuation uses methods such as comparing firms with similar characteristics. The goal of the comparative approach is to find a stock's notional price by looking at the price multiples of comparable companies instead of the company's fundamentals. Multiples like the price to earnings PE ratio and the enterprise value to earnings before interest, taxes, depreciation and amortization, EV/EBI TDA ratio are widely used. Comparable company analysis is an effortless technique to use. The identification of actually similar firms, however, presents the greatest difficulty. Why assign value to stocks? Despite what some may think, the market price of a stock is not necessarily equal to its intrinsic value, which is based on the company's underlying business strength. There is more than one method to determine a stock's worth, which is why investors give prices to stocks. Active investors who are confident in their ability to create and implement investment strategies that beat the market as a whole use an approach to stock valuation known as intrinsic value. A stock's intrinsic value is estimated using a variety of indicators, and active investors then compare this value to the stock's current market price. The efficient market hypothesis is accepted by passive investors, who believe that the stock market price always reflects a company's actual value. They assume that the stock price already represents all available information about the company and its prospects. To avoid the almost insurmountable challenge of trying to outwit the market, most proponents of the efficient market hypothesis advise putting your money into an index fund or exchange-traded fund ETF. Earnings, not any other aspect, are the primary driver of a company's worth. Earnings or profit are essential to every business's long-term success. When you stop to consider it, it's obvious. Without consistent profits, a firm can't survive. 4 times yearly, publicly traded corporations must disclose their financial results once each quarter. This time of year is known as earnings season and is watched very closely by the financial markets. This is because analysts' estimates of future profits are the foundation upon which the value of a firm is built. A stock's value increases when actual outcomes exceed expectations. A drop in share price usually results from disappointing worse than expected financial reports from a corporation. Naturally, profits aren't the only factor that might affect a stock's popularity, which in turn changes its price. If this were the case, the world would be much easier to navigate. Most dot-com businesses, for instance, had multi-billion-dollar valuations at the bubble's height but never turned a profit. We all know today that these valuations were unrealistic, and that the worth of most internet firms has dropped to a small fraction of what it was. That price fluctuated so much, however, shows that stock values are affected by issues beyond the company's immediate financial situation. Individual investors have created many indicators, ratios, and variables. If that's the case, then why do stock prices fluctuate? The most accurate response is that it is unknown at this time. While some say it's impossible to know how stocks will move in price, others insist that by making charts and analyzing prior price changes, you can know when to purchase and sell. The only thing that can be said with confidence is that stock prices are unpredictable and may fluctuate immediately. There is no one-size-fits-all approach to valuation. Instead, it is necessary to understand the firm to choose an appropriate valuation method. Moreover, traders may use a variety of models. An investor may do many valuations and use the range of values or averages to make an investment decision. When analyzing stocks, it's not always about using the best tool for the task, but rather using various tools to learn as much as possible. This was all from our side to guide you about the stock valuation. Please subscribe to this channel and press the bell icon so you don't miss any of the latest updates from this channel.